Since over the last 50 years, silver has been as high as 6.5% of the price of gold. And if gold went to 8,000, silver went to 2.5%, silver would be 10 times its current value. Okay. So in the final phase of the bull market, if that's what we're entering, and we think we are, we think it'll be evident, especially as we get into 2024. I think already the signals have been rendered by momentum. Right now, price is having its fist fight. Lag to momentum. But during that phase, so let's say over the next year or so, that's when the dynamics change. And you don't just get a bull market, you get a dynamic, but you also get silver to vastly outpace gold, which is what it did late in both of those other bull markets.
Silver has exhibited considerable volatility this year, marking a 6% year-to-date increase on the domestic front. In parallel, gold has witnessed fluctuations at both ends of the spectrum and is gaining momentum with an 11% year-to-date increase. In November, month to date, gold has seen a marginal rise, while silver has surged by 2%, mirroring an upward movement in industrial metals. However, in a notable turn of events, gold soared late last week, setting a new all-time high last Friday and breaching the $2,100 level in overseas trading Sunday night. Although silver also experienced an upswing, it continues to lag behind gold. In fact, silver appears significantly undervalued, considering its historical correlation with gold and the supply-demand dynamics. The price decline appears to be heading towards the anticipated target of $23.70, which was previously breached. This level is crucial as it represents the neckline of a double bottom pattern on the chart, influencing the next trend. If the price consolidates above $23.70, it may initially resume an upward trend, aiming for around $24.60. Renowned analyst Michael Oliver observes that silver's recent movements haven't required significant momentum to escalate, drawing parallels with historical trends. Silver underwent remarkable surges for precious metals like gold and silver during the final phases of previous bullish markets. Despite trailing gold for years in a bull market, silver has shown sudden and exceptional growth, surpassing gold's rate. Michael emphasizes the historical spread between silver and gold, noting that while silver currently represents approximately 1.3% of the price of an ounce of gold, historical figures have exceeded 2.5%, sometimes even reaching 3 to 3.5%. In theoretical scenarios where gold reaches substantial peaks, such as $8,000, he speculates that if silver reaches 2.5%, its potential value could be around $160 or even higher, considering historical spreads. Michael anticipates a potential considerable change in dynamics within the coming year, projecting a dynamic increase in gold and silver prices and a substantial outperformance of silver compared to gold. We will present clips from Michael Oliver's interview with Resource Talks. But before we do, if you want more videos like this, please hit the subscribe button and turn on the notification bell for more updates. Thank you and enjoy the video.
And look at what silver did. You don't even need a momentum chart. Okay, go back and look at a monthly price chart of gold and silver. In fact, we put out a report on this a month or so ago showing what happened in the dynamic final phase of those old bull markets. Silver went ballistic. Silver went ballistic. In other words, while it was an arm wrestling match and looked like a laggard, it was a laggard compared to gold for the first 6, 7, 8 years of the bull market. In the last year, when gold might have doubled, silver went up 4 or 5-fold. So there's a phase in the bull markets, usually late in the trends, when the other monetary metal, or what they call, poor man's gold, suddenly wakes up and goes ballistic even more than gold does. And I think we're near that point right now where silver, and we measure this technically, by the way, not just, we run spread charts, meaning the price of silver in relation to gold, but we also measure the momentum of the spread charts, looking for breakout structures. Silver is very close right now to where the momentum of the spread, which is starting to rise, by the way, favoring silver, especially since last year's lows. Remember, silver was down there $17 at that time. Silver right now is trading 25. Gold back then was 1600s, now trading 2050. So silver's already had a bigger percent gain off that low than gold has off of the 2022 low. But with a little bit more push by silver, it will cause its long-term momentum of the spread to break out into bull mode again. And we think that's likely to be timed with what we call the final phase of the bull market, the dynamic phase of the net price gains in silver and gold, where not only do they both go up more vertically, but silver suddenly starts to outpace gold vastly. Now, another point on that. If you measure the spread of silver versus gold, expressing the price of silver as a percentage of the price of gold, meaning right now, silver, for example, is about 1.3% of the price of an ounce of gold. Okay. Since over the last 50 years, silver has been as high as 6.5% of the price of gold, and many times above 2.5% the price of gold, even up to 3.5%. Well, let's say gold did a routine bull market and went to 8,000, matching the dynamics of the 1980 peak or the, et cetera, or the 2011 peak in terms of dimensionality. And silver went to 2%. That's $160 silver. But what if it went to 2.5%? It's been there routinely. You look at a spread chart of silver versus gold for 50 years. It's not like some rarity to see silver at 2.5%. It's almost like a normal inhale, exhale. And if gold went to 8,000, silver went to 2.5%, silver would be 10 times its current value. Okay. So in the final phase of the bull market, if that's what we're entering, and we think we are, we think it'll be evident, especially as we get into 2024. I think already the signals have been rendered by momentum right now. Price is having its fist fight, lagged to momentum. But during that phase, so let's say over the next year or so, that's when the dynamics change. And you don't just get a bull market, you get a dynamic one. But you also get silver to vastly outpace gold, which is what it did late in both of those other bull markets. It came to life then. Also, that to some extent is true with the miners. They quite often will lag gold until certain brief points, like 6-month bursts, where they go berserk relative to gold. Look back at 2020, for example, when silver doubled, $15 to 30 in about 6 months. Gold went from 1,400 over 2,000, nowhere compared to silver's gain, and gold miners like tripled during that time. Now, they gave it back since, but there's burst of time where the silver and the miners outperform gold. And I think we're on the cusp of one of those moments right now.
In the mid-'70s, gold experienced a surge from $30 to $250, dominating markets despite rising interest rates and a stagnant stock market. Similarly, after reaching its peak in 1980, gold remained at approximately $250 for nearly a decade before skyrocketing to $1,920, marking an almost 8-fold increase and echoing the pattern observed in the late 1970s. The price of gold has surged to an all-time high, buoyed by a decline in the U.S. dollar as traders increasingly speculate on the Federal Reserve cutting interest rates next year. The haven asset rallied by as much as 3% to $2,135 per troy ounce this week, establishing a new record before retracing to $2,025 per troy ounce, as per LSEG data. Traditionally viewed as a safe haven, gold is considered a tangible and scarce asset that theoretically retains its value. Gold prices have risen by 10% so far this year. Michael assesses the existing fundamentals and macro-technical indicators by drawing parallels between these historical trends and the current scenario, where gold has only doubled in value thus far. He emphasizes the anticipation of aggressive monetary policies amid the current economic climate, suggesting investors might shift towards gold amidst uncertainties in the stock and bond markets. Let's get back to the interview.
Okay, look at the bull markets that preceded us. You can start from the mid-'70s. Gold was coming up out of the $30 area. And, it went to 250, then it pulled back to 103, then it went to 850. Okay, over a decade, less than a decade, it went from the 30s to 850. And even if you want to measure just from, let's say, the 1976 bear low, which was a pullback from $200 down to 103, almost a 50% decline over a year and a half. If you start from the 76 low to 1980, well, you went from 100 to 800, 8-fold move. Okay. While rates were rising, by the way, stock market was doing nothing. It was a wasteland. And gold vastly beat commodities during that time, too. Commodities happened to be tagging along with gold to some extent during that several-year period. 8-fold. Okay. Now, then go back to the lows that occurred after the 1980 peak. In 2000 and 2001, gold got down to about $250 an ounce and labored there. So from 250 to 1920 over a 10-year period, you do the math, Okay, another almost 8-fold move. Okay, Most of that occurring, by the way, just like it did in 1979, the last year of that bull market. In 2010 to 11, most of the bull market occurred, compressed at the end of the multi-year advance. Okay, so far, we've only doubled. Yet you have these fundamentals we've been discussing, and also the macro technicals that indicate, oh man, the monetary policy is going to go berserk. We know it's going to have to. That's what central banks do. They have to save their government bond market. They have to save certain paper assets that they deem worthy. And gold is going to be the prime beneficiary of this as investors determine that, oh, I don't feel comfy being in the stock market anymore. Bond market's questionable, certainly was last year. What's doing well? Okay. So suddenly there's very few places to put it. So the money moves over there, and it always has over history. So if you do an eightfold from the 2015 low, we're at $8,000 gold. Is that abnormal? No, you've done it twice before in the last 50 years under lesser circumstances. So even just talking fundamentals and talking loosely, an eightfold move, oh, another normal move. Well, okay, but we don't have a normal situation here. We don't have a normal bubble breaking in the stock market. This is not 1929. That bubble was only a threefold bull market. It's not the 2000 dot-com. That was a three or fourfold bull market. It's not the 2007 stock market top. That was only a double from 2002 to 2007. We have a sevenfold or 16-fold bull market that's breaking, indicative of the monetary policy that fed it and is going to have to refeed it to keep it alive, or try to. Where's it going to go? Where it always goes. So therefore, you can put the 8,000 out there if you want, but all that is replicating the 1976 to 1980 move, mid-70s to et cetera. It's usual. It's normal. So I don't know where it's going, except a doubling is trivial.
Looking ahead, gold and silver are anticipated to move higher in 2024 due to the confirmed topping pattern in yields. The US dollar's limited upward movement confirms support for precious metals. What price levels do you anticipate for gold and silver in the coming year? Share your observations in the comments section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.